Thank you. So thank you very much for coming. And I would like to first thank Paolo for inviting me. I feel very honored to be invited to give a talk to you. And I hope that you'll enjoy things that I have to say. And as Paolo already said, this work was done with several other people in the consortium of European project called So Big Data. So with this, let me just start and I'll explain everything that I mean by the title. Just one second. Okay, so by the way, I have a chat in front of me, so you can ask questions and just let me know if something is not clear, or maybe there's some sort of thing that I didn't explain very well or you don't know about. So today I want to talk about a recent project that we did on information theoretic concepts that stem from the topics related to complexity science and we applied them to analysis of market microstructure. In particular, when it comes to studying turbulent events in cryptocurrency financial systems, and we'll be addressing a question as to whether different periods before and after the price peak in this particular market crash that occurred in 2017 are characterized by different information dynamical properties, suggesting the presence of two distinct regimes in which the system constituents operated. Okay. So first, why am I talking about complexity in this context? What is complexity? What constitutes complexity, and why I would argue that dynamics in cryptocurrency markets are complex. So complexity is generally defined as some sort of complex system is defined as a system in which dynamics unfold layers upon layers of complicatedness and non-linearities that occur at many different scales in space and time. They possess many different intricate feedback loops, and being open systems, quite often they're open systems, they're also affected by various unmeasurable exogenous effects. So financial systems fit the bill quite well for the definition, for the classical definition of complex systems. They're also composed, just as complex systems, they're also composed of many interacting parts that in which interaction aggregates exhibit properties that are not attainable by summation, and there exist nonlinear synergistic interactions amongst entities of the system of a view. However simple the rules in financial systems may appear to be, that is, one either buys a financial instrument or sells it, by which the price of the financial instrument is affected. Nevertheless, it appears that, well, the temporal dynamics of the price itself that we observe is simply a representation of a truly complex and complicated system underneath that gives rise to this time series that we observe, that time series of the price changes. So given the system, given that financial systems appear to be complex, the question then is, can we gain insights of some aspects of these systems and obtain an understanding of some sort of underpinning mechanisms using complexity science tools? And in particular, these systems may also spontaneously self-order, just as other types of complex systems, without any sort of external tuning of a control parameter. And in particular, in financial systems as a whole, and to be more precise, in cryptocurrency systems, this spontaneous self-order could be represented as a critical event, which would be some type of price crash. So then the question that we're trying to address is whether certain types of critical events could be understood using the lens of complexity science. So when it comes to cryptocurrencies, they appear to be even doubly complex due to the amount of collective interactions that lead to observed price and liquidity dynamics. They are therefore a unique laboratory to study ideas of complexity science, quote unquote, in the wild, applied to data without an obvious generative model that generates that data. So in short, cryptocurrencies are a novel financial instrument which is unique in the presence of distributed ledger technology that serves as a public database of executed transactions. So cryptocurrencies are usually transmitted via some type of peer-to-peer network with well-defined cryptographic protocols that record the system's state via the public ledger. And for example, in Bitcoin, that public ledger is also known as blockchain. So therefore, there's no central authority that is involved when it comes to price discovery. And that happens in a completely distributed manner. However, so despite their dissimilarities to classical financial systems, like for conventional currencies, the exchange of cryptocurrencies to other cryptocurrencies or to regular fiat money occurs in cryptocurrency exchange markets, which are based on electronic double auctions operating using limit order books. So in the slide, I'm showing an example of one such limit order book, how it could look. So simply put, a limit order book shown on the slides, on the bottom of the slide, represents, so essentially the limit order book is showing the, at any point in time, the available orders at many different price levels. So therefore the x-axis is the price. And one can distinguish different types of orders, either sell or buy, so bid or ask. And an order only is executed if someone is willing to buy at the price and someone is willing to sell at a particular price. And so we can also define spread in a limit order book as a difference between the best ask and the best bid prices. And the smaller the spread, typically the easier it is to execute the trades. Okay, so within a market, many currencies are traded, exchanged to one another and to fiat money. And therefore we have a somewhat network within the markets in the first place. And this system could be thought of as being open, because at any point there's both endogenous and exogenous information that is maybe affecting traders' decisions to sell or buy, thereby affecting the evolution of the price. So exogenous information here comes from in the form of out-of-market information, out-of-market signals, such as social media mentions, news, events, and so on, that could be absorbed by various subunits of the system and fed into the decisions when it comes to the decision as to what sort of next state the system will be. And so in addition to this type of information, there's also twofold information available within a market. And first, since many cryptocurrencies are being traded within the market, some type of quote unquote communication synchronization could occur. When the price of Bitcoin, for instance, drops, traders of another cryptocurrency, let's say Ripple, could be affected, get scared or excited about this financial instrument. And thereby the change of Ripple is somewhat affected by the change in the price of Ripple can be affected in some sort of way by the previous price of Bitcoin. So even more so, traders of different assets can be simply exploiting some type of monetary benefit in the form of arbitrage, and thereby synchronizing the prices, so creating some sort of correlations between the prices of different currencies within a market. Further, we also have various types of market microstructure observables. So I'm just showing this with this sort of interacting mini network. Various market microstructure observables could be influencing one another. Such as observables could be liquidity of an asset, spread in the limit order book, price returns, volume of trades, volatility, and so on. So all in all, price within the market is processed collectively in a distributed manner. However, not only is the price, so it is important to note that in addition to inter-market connectivity, we also have connectivity in between markets, because unlike conventional trading, the same cryptocurrency can be traded at many different venues, many different exchange markets. So in fact, we have a system that looks more like this, as some sort of modular network. We have a network within each exchange market, but also we have a whole collection of such markets. Therefore, there are various types of interactions within a market, but also across markets. Any two crypto markets could be thought of as being connected, coupled when there's some type of mutually traded currency, or some type of arbitrage opportunity, or when simply prices of cryptocurrencies among several markets are correlated. So the price of a cryptocurrency across different markets is synchronized. There's no such thing as Bitcoin in a market A and Bitcoin in a market B. There's just the same Bitcoin. And so in the long term, in long time horizons, the price of one cryptocurrency, synchronizes because of exploitation of various types of monetary, so many types of arbitrage and so on. So all in all, for any cryptocurrency, the price is processed collectively in a distributed manner, and the dynamics of the price is affected by both internal feedback loops, but also by exogenous unobserved information. So it is not clear, however, what type of information is important and what type of information the system responds to when it comes to forming the new value for the price. For instance, the communication. So this is the question that we're trying to address during this project, and we're doing this in the context of a real Bitcoin market crash that occurred in the year 2017, and the dynamics of the price near the price peak are shown in the figure. The price bubble is also unique in that Bitcoin was still a dominant cryptocurrency in 2017 with the largest market capitalization. So to understand the potential changes in the way that system subunits were interacting during this market crash, that may perhaps indicate the change in price direction, we first studied several models, several econometric models that would help us understand the results that we would later on get from model-free data analysis. So first, we studied an econometric model that coupled market microstructure variables in order to understand whether tools from complexity science, namely the information dynamics, and in particular transfer entropy, mutual information, and active information storage can help us detect coupling between different market microstructure observables, such as relating price and liquidity. We also want to find out whether a particular coupling change is detectable with information dynamic tools. So given these insights, we analyze the persistence of information dynamical patterns that signify a particular regime shift associated with this particular turbulent event. And importantly, I just wanted to clarify that in the following, we did not attempt to model a regime shift and infer it from the data. On the contrary, based on the observed price dynamics, we tested that the hypothesis that the periods before and after the price peak are characterized by different information dynamical properties, suggesting the presence of two distinct regimes. So information dynamics is a complexity science tool which we are considering in this work to gain insights about the distributed computation within the Bitcoin market ecosystem. Information dynamics is built upon the notion of entropy and mutual information. So entropy is the definition of entropy is the following. It is the average uncertainty in the value of a sample of a variable, equivalent to the average information required to predict the value of a sample. In simple terms, the more yes or no questions one needs to ask about the variable in order to understand the actual value that the variable takes, the larger the entropy for that random variable. And in particular, if we have and in particular, entropy is built upon the idea of information of the, so the surprisal information, where the more rare the event, the more information it's assumed to convey. And the more common the event, the less information it's supposed to convey. So mutual information is a similar, it's a similar concept. Mutual information is defined as the amount of shared information between two random variables, and it's a measure of statistical dependence. Therefore, it is equal to 0 only when two variables are independent. We can also generalize mutual information to be applicable for more than two variables, in which case we call it multi-information. So lastly, it's important to note that both entropy and mutual information can be framed in the context of another variable conditioning on it, in which case we have conditional mutual information and conditional entropy. And so, for instance, for entropy, the entropy of x given y conditioned on y would be the amount of uncertainty that remains about x once we observe y. So, and I think it's easy and convenient to visualize these different information theoretic measures using Venn diagrams shown on the slide, where each sphere represents entropy for a variable, and then the intersections represent conditional entropies and mutual information. So these information theoretic measures for static variables, so they're built for static variables, they can also be adapted to analyze stochastic processes, in which case now we have some sort of sequences of random variables xt and yt, and intuitively the processes x and y could be associated with these random variables. We have a random variable for each time step, and so the entire evolution for this set of random variables is some type of stochastic process. And with this dynamic framework, we can start asking questions that are a lot more dynamic in nature. We not only can we quantify the shared information between two random variables, but we can also try to see whether there is some sort of lagged information flow and so on. In particular, the questions that we can ask are, for instance, how much memory a stochastic process has, and how much of information from its own past it's using in order to compute the next state that it will take. Another question that we could ask is how much integration or synchronization across system subunits there are at each point in time. And lastly, we can ask how much information is transferred at time step t from the past of some sort of variable y to the current state of x. So these questions can be addressed with information dynamic measures. And in particular, we will be considering free in this project related to the free questions that I have just raised. So first, the active information storage is a measure of memory defined as mutual information between two random variables associated with the consecutive time steps of a process. So qualitatively, it captures how much information is available from previous time steps of a process, and when it comes to computing what the next state of the process will be. And it is also similar to a measure of autocorrelation, which some of you may know. And next, mutual information or multi-information when it comes to more than two random variables. It measures how much shared information there is between two random variables associated with the same time step with different stochastic processes. So we're measuring some type of synchronization between a couple or more processes. And if two processes are independent, then the mutual information is 0. So it is essentially a nonlinear measure of correlation. And lastly, transfer entropy measures how much uncertainty about one process is reduced from the knowledge of the past of another process. And it may be interpreted as the degree of uncertainty about the current state of X that is resolved from the past of Y. over and above the knowledge, the information that is already available from the past of X itself. So these three measures can vary in time, and the change in the absolute values they take as time progresses in our system is what we're after. So we first analyze the capabilities of inferring these information dynamics within a cryptocurrency market for a given exchange pair. So in particular, we are concentrating on Bitcoin in this project. So it is plausible to assume that at high frequency, so at small time increments, a price of particular currency depends on various aspects that can be deduced from market microstructure observables, including communication amongst observables such as spread, trades that are being executed, price, the direction of price that would be price returns, volume of trades, volatility, and so on. So we considered information dynamics amongst these three variables and that are computed from high frequency market data. And in particular, we looked at three, so spread, which measures how easily the trades are executed, and so is a proxy of liquidity. We also looked at returns, which measure the price direction of change. And lastly, order imbalance, which is deduced not from the data from limit order books, but from executed trades. So it's a measure of the prevalent type of trades, either sell or buy. And so that also has a relation to the direction to which the price is moving. So within market, we can then consider how much memory each variable has on its own, how much it's synchronized with other variables, and how much transfer entropy there is between a pair of observables. So inference of information dynamics from empirical data is an incredibly intricate matter and has to be done in a somewhat scrupulous way. Otherwise, one can easily detect spurious relations, correlations, and so on. So with this in mind, we first checked whether for realistic data that would reflect on certain features of financial markets, we would be able to detect information flows between, information transfers between different observables, such as returns and price returns and spread. So this is what I want to show with this slide. We analyzed a model of coupling between different market microstructure observables, and in particular spread and returns, using a variant of generalized autoregressive heteroscedasticity model, which couples returns to spread at a time delay. So similar to a standard gauge model, we have, so in addition to the standard model, we have two additional terms which couple spread and returns via these two extra terms that I highlighted. And so these two variables are connected via volatility signal. And so, right, so let me show you an example of how information transfer can be inferred for these simulated time series. And in this case, I am showing the information flow from expected information flow from spread to returns. So we have non-zero value for gamma, but zero value for B. So we expect the information transfer, non-zero information transfer from spread to returns, which is shown on the left figure, but we don't expect to see any information flow in the other direction. And so our results agree with what we would be expecting qualitatively. However, what is even more important is that we not only can we infer the results from time series, but we can also obtain an analytical expression for the amount of information flow, so for the absolute value of information transfer that we would expect from this model for given parameter values. So this is what I'm showing in this figure, in which the theoretical model-based values were obtained. So the information transfer from spread to returns, the top figure, seems to show values that converge to around 0.02, which is similar or close in the absolute value to what we see in the data, which is shown on the left. So all in all, nonlinear transfer entropy measures can reliably detect certain types of nonlinear coupling between different market microstructure observables, in which case, in this case, we were considering spread and price returns. So next, we move to a question as to whether by looking at combination of these information dynamic measures, we can detect a change in communication among system subunits, and whether different types of regime changes are distinguishable amongst one another. So when it comes to different types of possible communication among system subunits, several different types can be distinguished. For instance, the system as a whole can be highly correlated, synchronized, and sync. In this case, a regime shift would represent a change in the system synchronization level. One can also think of this case as a presence of some sort of hidden driver that is quote unquote driving the system, and its strength is changing over time. And an alternative scenario is when there's a lagged coupling between observed system subunits. So system subunits are affecting the other system subunits with some sort of time lag. And the influence with which the subunits are interacting are changing over time. So to model these cases, we considered two coupled autoregressive processes of this form. So notably there we have a time delayed directional coupling from X to Y, whose time varying strength is defined by capital C. And it's modeled as some sort of sigmoid function that is changing in value at a critical time TC. And we also have some sort of simultaneous common time varying hidden driver, which is realized as a common noise term. So in here, we can see that we have the same noise term. And the strength of this noise term is defined using the time varying strength K, which is also a sigmoid function. And so we consider two cases. The first case is when causal coupling strength capital C is changing over time, but capital K does not. And the reverse, when common noise strength is changing over time, but the amount of information transfer does not. So in the case of a regime shift of a causal driver, what we find is that we observe that there is a significant change in transfer entropy that is shown in blue, and the change occurs near the critical point. So we also see a change in active information storage, whereas for mutual information, we observed no change. Similarly, in the case of a regime shift of a hidden common driver, we observe the change only in mutual information and active information storage, whereas for transfer entropy, we see no change when we compare the two periods before and after the critical point. So all in all, it appears that synchronization or information transfer driven regime shifts are signified by changes in information theoretic signatures. Lastly, we studied a case when lastly, what we also studied is potential change in something else, not necessarily the communication between two variables, and whether that can be falsely identified as a regime shift. So in general, a seeming change in communication could also be due to some sort of change in the parameter values. So for instance, we can see a regime shift in the amount of uncorrelated noise present in the system, and that could also appear to be a regime shift in the communication patterns within the system. So to see this, consider time varying parameters that relate the amount of uncorrelated noise in the system. And what we see when we simulate this is that all three information dynamic measures seem to be high valued at one side of this transition and low valued at another side of the transition. So this example emphasizes the need to look beyond just transfer entropy, which is quite often done in analysis of financial data. If we want to truly understand what is happening, what sort of changes happen in the system, So all in all, what I wanted to say with this example is that by looking at the combination of information dynamic measures and their values changing over time, we can deduce the changes in the information landscape the system lies in. And here we showed that increase in multi-information could be associated with the change of synchronous coupling present in the system, whereas the increase in information transfer could be could signify the increase in causal coupling present in the system, while simultaneous increase of all three information dynamic measures considered could signify reduction in overall systems uncertainty. And lastly, I wanted to mention that we tested these signatures, these information dynamic signatures for a wide range of parameter values, and they appear to be quite robust. Okay, so now we're equipped with all necessary modeling tools to understand, to gain insights about the information dynamics that occurred during the 2017 Bitcoin markets crash. So our main question is, were or were not the periods before and after the price peak characterized by different information dynamic properties? So with this global question in mind, we concentrated on two particular hypotheses. So first hypothesis is related to inter-market connectivity, inter-market information dynamics, and a potential change in the way that inter-market dynamics happened. And the second hypothesis relates to intra-market dynamics, so in between the different markets, and a potential information dynamics-based regime change in this case. So the data for this analysis is tick level trading and order book data, and we considered the data aggregated to minute level frequency. And for preceding analysis, we restricted ourselves to the most liquid and largest cryptocurrency, that is Bitcoin, traded against either US dollar or Tether, which is a stable coin designed to be equal to $1 at all times. And we also considered at the time 10 largest Bitcoin trading venues. So we looked at the data that consists of Bitcoin market crash. So the price of Bitcoin peaked at December 17th in 2017. So we considered this point as a quote unquote critical point, using which we divided the data into two subsets, before and after the price peak. And lastly, from this raw high frequency data, we derived these three market microstructure observables that I mentioned earlier. So spread, returns, and order imbalance. So we calculated the values of information dynamics for each market individually. However, to understand the system as a whole and how it evolved over time, we need to aggregate these values into something that is representative of the entire system. So for this reason, we considered market averages for each of the measure of information dynamics. That is, for instance, for active information storage, we report that is going to be reported in the following. We consider the market average for each of the market microstructure observable. Similarly, we obtained a market average of multi-information for each observable with each other observable within the market averaged over markets. And in a similar manner, omega in represents the market average of intra-market information transfer towards a particular observable from every other observable within a market, averaged over markets, and similar for omega out. So we compared this information, intra-market dynamics to inter-market dynamics. For this reason, we considered synchronization via multi-information. So synchronization across markets, which is computed as multi-information for an observable observed across different markets. So we take one observable for each of the markets and compute synchronization across markets via a given observable. And lastly, omega self represents the amount of information transfer that is shared across markets via a particular observable. And by appropriate averaging, we obtain values that are comparable That is, we can compare the strength of various types of information dynamics within a market to information dynamics across markets. So coming back to the original hypothesis of a presence of a shift in information sharing across markets as the system transitions from price increase period to a price decrease period. To test this hypothesis, we divided the data into a period before and after the price peak, aggregated the information dynamics results from markets into something that is representative of a system as a whole. So we obtained something that looks like this. So the table shows the observed inter and intra-market information dynamics that appear to shift from high values at the period before the price peak to lower values during the period after the price peak. So to test which of these values are in fact significantly different, we tested for a hypothesis that the observed dynamics before and after the price peak were on average different. And we performed this test for each information dynamic measure individually. And so the results highlighted with the asterisks show the values that appear to be significant when contrasting the values observed in two market regimes. So in particular for spread, both intra and inter-market communication changed significantly, whereas for price returns, we see that memory in use, so active information storage, changed significantly, as well as intra-market connectivity. For order imbalance, we observed no significant changes. So all in all, the different periods before and after price peak for certain information dynamic measures and for certain market microstructure variables appear to be different. And we can also perform a test that quantifies whether the changes were significantly different. So I can see that I'm overdue with time. And so this is a concluding slide, which just reiterates everything that I have just said. So with this, I wanted to finish. Thank you very much for listening to me, and I can try and answer all the questions that you may have.